think one of the most pertinent questions right now everywhere, role of banks in gold loans, gold monetization scheme and the sovereign gold bonds. Our moderator for this session, Professor Charan Singh, the RBI Chair Professor at IIM Bangalore, who would be chairing this session too.
At the outset, let me thank the organizers, especially Mr. Srivastava, for inviting me to come and be here and moderate this session. For me, it's a privilege and honor to be here because I am a student of gold market. Though I have been into the gold and gold related things for a couple of years. First when I was in the Reserve Bank of India and the research director for banking. And then when I joined the Indian Institute of Management, Bangalore, and I thought this is one area on which research has not been sufficiently done, already alluded to by Professor Sahai, and wanted to take this over. Also, that was the year when gold imports were very large, and the government of India had to use a sledgehammer to control gold imports because our current account deficit was far larger than the tolerant limit of any country. Given that background, I wanted to mention that in the last 4 years that I have been doing research on gold and gold markets as an academician with my students, and these are my MBA students, so not PhD students, the research has not been very thorough, but has been reasonably good quality. We brought out a working paper also at IIM Bangalore's website, you can see it, where we said what is happening in the gold market. So a couple of things which I would like to share before I go on to the panelists. One thing we realized is probably the figure that we generally talk of, total gold in the country being just 22,000 tons may not be the right figure. Maybe there's much larger gold in the country. It's pertinent for all of us because when we say we want to monetize gold, we have to know how much gold is there and what our estimates are based on. The second thing, when we started talking to people, and this is last 4 years and various teams, my students have been going and doing surveys, we started talking to people and wanted to know why are they holding gold? And what is that love that Indians especially love gold so much? What is there in the head of an Indian, in the brain of an Indian that he rushes for gold? And I was very surprised to see that we generally think Indians are illiterate, naive, not highly educated, not financially very wise. Sorry, what we realized is they are hedging against uncertainty. And all types of uncertainty that the Indians are plagued with. There could be market uncertainties, there could be inflation, and therefore gold is the safest haven. There could be important occasions, education of children, marriages of children, purchase of a house, bulky investments are required, so small investments can be made in gold. And of course, then there is old age, so serving as a social security because social security does not exist. So it was interesting to find out what is so unique about the Indian mind, Indian brain, that the rest of the world is not so crazy for gold, but the Indian mind is. We also found there are regional differences in preferences for gold. There are also differences related to literacy levels of the individuals and also differences related to your income standards, which was very surprising. As an illustration, Bangaloreans prefer a different set of gold ornaments than people in Ludhiana would prefer. Of course, in those interactions and surveys, we found there are differences, and we found that the role of institutions is very important, and I'm talking of December 2012 and 2013. The government had yet not come in. After 2012 sledgehammer within the country, we started talking that the government needs to mobilize gold which exists within the country. And so the role of the government and through the bankers, how the gold monetization scheme should work, what should be the role of the jewelers, all those issues kept coming up. So we kept meeting the stakeholders and interacting with all of them. Right now I'm in the middle of another research, and that is again what Professor Sahai alluded to. I'm trying to understand why the gold monetization scheme is not a runaway success. And so for that we have been again interviewing different people in the country, and this time, in addition to dwellers, common householders, we have also interviewed lots of people from the temple trust, and surprising, we found some very interesting answers. The temple trust, where I believe huge amount of gold does exist, have been telling me that we are simply trustees of God, the temple, and therefore we cannot part this gold. This has come to the temple, the trust, over generations and is meant for future generations. We just cannot part with this gold. The second thing they are telling me, people come to the temple, make donations, sometimes unknown, but most of the time known donations, and then annually they come for the same purpose, either parents or business, and they want the deity to be adorned in the same gold sets that they had given. So therefore, we preserve that gold which has come to us, and we respect it as the wishes of the people. The third thing they tell me, and this is very strange, that why are only temples being targeted for gold? Why not other places of worship? And many times when they look at me, they remind me of the golden temple at Amritsar. But there are other places of worship where lots of gold is there, and why they are not being tapped. Incidentally, in the survey, and we'll be coming out with our working paper again on it, we will be writing all the details and my own interaction with temples of different religions. The other thing which we are now trying to do survey is the general issue, and what we are realizing now, market is not a very convenient place for monetization of gold. So my students have gone into the market, experimented with gold in their own hands, and see how easy it is to get it monetized, and they found it's not very easy. Surprisingly, the CPTCs are also not conveniently located, and my girl students are not even feeling safe going to the CPTC. And of course, the last thing, which is the most important, I think Professor Sahil's research can be very helpful in that, the fear of the tax authorities. How do you show a tax man laughing and taking care of the fear that I'm not sure, but I think it has something to do with the psychology, the scare that if they come out with gold, it may really get them into the tax man. That finally brings to the point that the general perception is, given lack of instruments, given the volatility in inflation, given the avenues for investment, unless they are made available, gold is the best investment. And coming from any source of income, indiscriminately, gold serves as the best form of investment. So, today our session is on banks, and I would now like to introduce my panelists, and we would like to go back and see what the bankers have to say. So, we have followed a certain pattern of presentation today. We are going to start with my colleague from the Scotia Bank, Mr. Johnson Lewis. The Scotia Bank is in a different set of business as far as gold is concerned. He's been in this business for a very long time. I think the longest time of all the people on this panel. So I think it will be very interesting to listen what he has to say. And then we are going to go over to Ms. Dimple Chitnis. She is the Group Executive VP of the Yes Bank. And I always tell, well, we have a Yes Bank, but then the banker of the bank, the Reserve Bank, has to be very cautious and can be easily called as the No Bank in terms of gold. So we will have, I'm sure, a very good presentation from the Yes Bank. I know Mr. Shekhar Bhandari for a long time now from Kotak Bank, and he's going to bring in a wealth of information. Of course, he's to do a lot on policy, and we will then go back to the Kotak Bank to listen about his experiences. And finally, we have Prashant Upadhyay from State Bank of India. I always say State Bank of India is a sort of a monopoly bank in the country, be it the public sector banks or be it the private sector banks. He's been into this for a couple of months now, but his knowledge base is strong. His institution has been into it for a very long time. It will be interesting to listen to him. So what are the issues that the four of them will be presenting to us, and then I'll be driving my conclusions and coming back to you we are trying to address three key issues. One, of course, the size of gold loan market. How can we expand it? And what are the hitches there? And what are the solutions that can be expanded? We'll be trying to answer questions like, can the ticket size be lower? Can we have a rupee price gold loan product? So those are the issues which we are trying to tackle. The second is the GMS, the Gold Monetization Scheme. I thought it would be a runaway success. It did have a good beginning, but I don't think it has made the dent which we were expecting it to make. So the panelists will be speaking on that. And finally, the Sovereign Gold Bond Scheme, which is doing well, and what are the ways we can take it further. So without much ado, let me go down to the panelists right away, and we will starting with Mr. Johnson, who is from the Scotia.
Today we are discussing the subject of role of banks in gold loans, gold monetization scheme and the sovereign bond. The gold loan, of course, is a pet subject of mine because we have been one of the few banks who started the gold loans somewhere in 98, 99. And I remember marketing this product, and initially we literally struggled to convince our clients on gold loans because traditionally clients were used to taking the price risk. They had seen gold price move higher all the time, so they were happy to buy gold and then wait for it to keep going up. So they always felt that they were getting the benefit of the price uptick. Over the years, I've seen it has grown definitely. A lot of our clients have understood the product, and we have seen some real decent rise in the demand for gold loans. There are also for the challenges in the gold loans where customers have to be aware of their margins. They have to top up margin when the gold price goes up. So those challenges are definitely there. It's important. What we have done in Scotiabank is also try and have seminars where we educate our clients about the gold loan product, and so that they are aware of the risks that are there and how they need to manage and hedge their positions. Insofar as the gold monetization scheme, yes, we have not really seen much happening there. It is before the gold monetization scheme, we had the gold deposit scheme. And again, most of the deposits that have come through the Temple Trust. We really didn't see coming from households, and that has always been a challenge. In the gold monetization scheme, we have seen that there will be a few changes with regard to who can the CCC way and collection centers or thing. But again, we have not seen real traction. I'm not much into the gold monetization in the sense that we are not a retail bank, but I'm sure my friends here would be able to give you an experience of what they feel the gold monetization scheme, what is their experience of collecting gold on smaller quantities and how they perceive the business there. And with regard to sovereign bonds, yes, there's been 4 tranches of it. We have seen some good decent progress, but I personally feel that the sovereign bond should be on tap. And if that happens, then definitely we'll see more investment on sovereign bond.
So with this, I think we'll move over to Dimple Chutnis, the group executive from Yes.
I'll straight away start with the role of the bank for gold metal loans specifically. I think it's a very powerful product and a tool for customers to hedge their inventory as well as manage the positions on the gold price. To be very fair and honest and very candid in this forum, I think this is one of the key products of the bank. And having started and probably being the last entrant in the space, technically I feel this is the best product to go out to clients to. Why I feel it has been stagnant over the last couple of years. If you look at it, it's pegged more or less to 10% of the gold that you import into the country. So the typical tonnage across the banks that you're all sitting here, it should be in the range of 50, 60, 70 odd tons. That's a ballpark number that I carry. I think one of the reasons why in the recent past, I would say for the last 6 months also, it's not picking up is because of the parity of the gold price available in the domestic market. So thinking out very loud as a suggestion, and I don't know how this will be taken up, maybe banks should be allowed to source domestically to be able to pass on price benefit to customers and have a fair level playing platform, vis-a-vis the so-called competition that Also, I feel that from a perspective of a tenor of the gold metal loan, from the perspective of a qualification of the gold metal loan, technically it should work like any CC product. So it's one unique product which is dollar denominated for a domestic use of a customer. Hence, I think it should be completely linked to the working capital cycle, and hence banks should play a very pivotal role along with Reserve Bank to not really have a stipulation on the gold metal loan and restrict it to 6 months or to 70 days, but factually link it to like any other funding product based on the debtor cycle management. That would give the flexibility to customers again to be able to treat it like at par with a CC product. So in my view, GML is technically the way forward for us. Unlike GML, there are also other banking tools which we provide to our customers, which can again act as a very, very competitive source of funding, cost-effective products which are available in the market now through the equalization scheme, which effectively help at least the exporter gold customers to avail very, very competitive pricing in the market. And as a that's what our strategy is going forward. With respect to reach and education, I think also this product has not picked off in many of the tier 2, tier 3 cities, and that's our experience at Yes Bank, and I can speak on behalf of my bank here. So I guess education, reaching out to more and more manufacturers and jewelers was again one of the way forward to increase this book size and increase the tonnage vis-a-vis the gold that we import. From gold metal loan, moving on to the gold monetization scheme, definitely there have been good clarifications that came in January 2016, which gave a lot of clarity to banks in terms of hedging up, our positions on the OTC or international markets with respect to the gold that we monetize. Also incentives to us of 1% and 1.5% that was provided to us. Typically, is a great boost for the medium and short-term structures. Tax exemption clarities which came out again are initiatives taken by the government to boost this. Yes, it has its challenges. Definitely on the ground, it's far away from reality. At our end, specifically, the challenge we face is, of course, the emotional quotient of an individual person to come and deposit and partake with its gold, and the procedure. The fact that you expect an HNI customer to go through the whole SA process, be physically present, yes, it's a veteran. Secondly, also I feel that the benefits to a bank to be very attractive on the deposit rates could also be, relaxation on the CRR and SLR load that the bank carries. And if that is done away with for short term, I think we can pass on better interest rates and attractive interest rates to the individuals and peg it at parity with the other investment products. So from our perspective, on GMS, I would categorize it to 3 people, which is individuals, HNIs, and Temple Trust. Temple Trust don't entertain private sector banks, and I'm sure my colleagues on this dais are going to have the same view. We are told that obviously regulatorily through the board, through the trust board, they cannot really talk to and entertain private sector banks. So I don't know what chance or hope we have, if at all any, to be able to monetize that part of the gold. Individuals, yes, I think we all know the story. We've garnered, I guess, not more than 3 tons through the scheme. Hopeful that it should pick up, but has a lot of ground reality challenges in terms of operational procedures and cost to the individual customer. On the other hand, the bond scheme, which I think is definitely a good product. All the, if you compare it to the ETF markets, the positives are obviously on the side of the fact that you have no management charge, which typically up to 1% is what gets loaded onto the customer. You have a fixed interest return of 2.75%. I think it's a fabulous scheme. I think it's very attractive. And the other benefits also that after all it's a sovereign bond, most credible bond, or this credibility that an investor can carry with him. And at the same point of time has some parts of negativity to it, is because it's like Johnson rightly mentioned, there should be a set frequency that should be there for investors to be able to time their investments. Maybe government can come up with some timelines in certain quarters that they would come out with the scheme, and hence customers are more planned to do their investments, because here and currently they're at the mercy of not knowing when the next scheme is going to, or the next tranche is going to be rolled out. Also maybe, just thinking out loud, a threshold of 500 grants to be increased for certain category of customers so that they can mobilize and come and invest more into the scheme and create a way forward for us. So from banking world perspective, yes, the banks are very keen to partner with the government initiatives, and certain enablers and tools are the way forward for us. And at the end of the day, we feel that in all initiatives, banks play a very pivotal role. And with this, I'd like to hand it over to Mr. Charan Singh again.
So we'll now go to my friend Shekhar Bhandari from the Kotak Bank.
Hi everyone. A couple of things, Professor, and I think I compliment Professor Sahai for showing us a new thought. I think we always felt that there is some science behind it, but to explain it through the Wadala crossing was an excellent example of showing yes, that is what is required. In my mind, I think government did try to address it in terms of policies, especially on the gold side and the thought being changed. You have to compliment government the way they moved from 2013 till now in introducing two, I think, critical schemes. Sovereign gold bonds, if standalone, government taking a risk on the price of gold, ever to think that government will think like that and launch it, I think it will be too much to expect. But I think they went ahead, took that, and I think launched it. At times people see with the quantity which has been collected or the amount which has been collected, I generally go by the number of people who applied for it. And I think that gives an excellent story. If you see that if more than 1 million people have come in and invested in gold sovereign bonds in the first 4 schemes, I think totaling around 8 tons all, but important is 1 million people came in together and invested. And if 1 million people invested, I think 20 million thought about it. And if 20 million people have thought about it, I think it's a good beginning. And when we give our feedback, I think which happens on a regular basis to the government as well, you realize that I think yes, the expectation was that the number should be much higher, but the number of people to invest was not expected that much. And that is, I call the first compliment, and I think the banks are, active enough to come in and invest in that. The way the government monitors these part, I think is something to be complimented on. I call it very much like the principle of my son, and I think if a son is not doing well, the teacher will call you or the principal may call you probably after a month or 2 months to give a progress report. Just to tell you, I think the ministry takes that stock from the chairmen of the bank on a regular basis. And I guess I have not seen so much of seriousness and a thought or something like this being put on. Yes, it is a push mode, but 1 million people in a sovereign gold bonds, I think is a big takeaway. With the government taking the price risk on gold, I think not very easy. And in India, I think not very easy. I think I can very well tell you. Gold monetization, yes, I think my expectation would have been much higher. There are processes and there are many things which are involved, the pricing which is involved in the entire part. And if a customer has some part of challenges in getting the gold, if the bank doesn't have enough benefit of taking it, and if the cost of distribution is high, I think policy-wise a good scheme, but I think when it comes to execution and I think benefiting all win-win-win, I think it has to be made, I think, much better. And then this will be complemented with, I think, what Professor Sai spoke, that yes, it is a push, but I think when 20 million people are hit, if I see a similar number of customers coming in and getting interested, I think it will be a good thing to take away. Gold loan is something which is a hedging tool which is available to Indian corporates. Many tools were not permitted in the banking industry for Indians, but I think the gold guys were lucky. They had a UP and a gold built in, a fantastic product available to them at international market prices. And as I think the education went up, I think the banks came in. I think it's a good product for them. It is important that the people who take it use exactly the same manner as it is designed. There are people who would like to first assume that it is a loan at 3.5 to 5.5%, and accordingly it is comparable to a 12% or 10% of rupee loan. Yes, I think the 10 and 5.5 is not comparable. I think one is with a risk on the dollar and gold, the other one is totally rupee. Second part, I think people do say that it is to be complemented with the sale which happens, or I think the working capital cycle which the customer has. If you have it matching, I think it is the real product, and in real sense it is a cost. But we have seen organized industry going up. I think gold loan product becoming popular. Yes, I think all the friends I think on the desk has been I think very active in it. A couple of us being pioneers in it. It is good to see, especially the same part, number of customers growing significantly from what it was 5 years back. In our own side, I think 5 years back we didn't have a product, and I think every year one has seen, I think last year one has seen the number of customers grow by almost 300% in terms of the customers who come on board and take gold loan. And since you have good risk management practices in place, yes, I think it is good that I think it passes through the system and I think analyzed quite well. The way the market is moving that the risk and the loan should be I think combined and done together, and we have seen I think significant transformation on that side happening in the marketplace, which is a good part, which means I think earlier bank A used to take a risk and the bank B used to give a gold loan. Currently we are seeing the convergence of that. The way the banking industry is seen, I think I generally always compare banking with mutual fund. Mutual fund runs 70,000 crores of assets with 100 to 300 crores of expenses with 0.75% as a cost on the cost of administration. I think banking is probably at 300% much costly. So you will see the cost converging on that side. You will see the same thing happening, I think, especially with the gold side as well. On the policy side, I'll say I think the government has moved. I think they moved the needle. Their concerns remain on black money. They think gold is one of the areas where black money may be addressed, hoarded, etc. We have to, I think, work on the same. I think as neuropsychology, which I think Arun spoke, that we have to have the same thing in the government as well, that we are becoming a fair player, and I think we can address their concerns on black money. Besides, I think current account deficit we have resolved, I think it's significant. Overall, just to conclude, sovereign gold bond, in my mind, 10 lakh or 1 million customers, I think good part. Monetization, I would expect push, I think coming well. There has to be enough pull, I think, from all the sides. Gold loan, I think you will see, I think, as we progress, as customers become more mature and more educated, they will try to, I think, towards this side.
We have our friend Mr. Upadhyay from State Bank of India.
What I do is, GSB has given a particular broad outlook about all the three schemes, on which he wanted some reaction from the banks. So I'll start with the gold loan, and I will answer some of the questions which have been raised. First is why the market for gold loan is not expanding. The answer is 20% of the market, is organized, 80% is unorganized. For a bank to lend to an unorganized sector is a little bit of a difficult task. It makes the going a little bit difficult. You have to maintain the supply chain, you have to monitor the everyday operations. That becomes a difficult task. The second issue is with the price rise which we are seeing in the past. What is happening is the supply side, the recycled gold has come in a huge way. Somebody says that 80% of, some jewelers say that 80% of their supplies are from the recycled things. People are encashing on the price rise. So you don't face the demand from the GML side. You don't need money. The other issue which affects the demand for the gold metal loan is the tier 2, tier 3 cities, the demands are not very large. Now what happens is the large bullion dealers, they will take it and they will sell it to the small players. So the trade basically goes on the cash basis rather than on a loan basis. So that also is affecting the demand for the metal gold. Now what happens is in case of a gold metal loan, most of the other players, what they do is they will be extending this loan against the SPLCs. They will get a comfort in terms of a bank guarantee. I mean, what comes in the way is, we are a bank we are a traditional bank, we go by the working capital cycles. I can give you loan in rupees also, I can give you loan in the metal gold also. But if I do the appraisal, then the collaterals are not more than 100%, which happens in case of a bank guarantee. Maybe the cost factor, if you work out, somebody else is taking that risk, that's a different issue. So that also is a factor which affects the metal gold loan. Rather than metal gold loan, people buy in rupees, then the trade goes on the cash market basis. Now the second question is, a lot of times this has been raised by many of the jewelers, that you extend the period of the gold metal. Once again, the argument is our lending depends on the working cycle. So if the working cycle for the jewelry is 2 to 3 months maximum, where they can convert their raw material into the finished goods and get the sale proceeds, there is no point in extending this metal gold loan cycle. It will only result in people taking some exposure which is undesirable based on certain their own judgments. And as a banker, it's a difficult proposition to lend against those kind of assumptions. Now the other issue was, can the collateral be more broad-based? So I have already said that we do the assessment and the appraisal based on the various factors, which includes the working capital cycle, capacity of a particular person, and the collateral part of it. So there the role of collateral is only say to the extent of 20%. So what we do is it's fairly fair risk in terms of at least 80% I am extending by way of finance. So increasing collateral so far as the banks which are also into the rupee lending for the jewelry makes no difference. It is always better to buy from a bank which can give you on your working capital cycle, and with a small collateral to take care of any variations in the prices. Now, can we have rupee priced gold metal loan product? We can have, provided you have an Indian gold standard, you have an Indian gold bar, you have an Indian exchange rate like a London Bricks, which of course is the responsibility of the industries to come out, and something is going on. I was reading in newspapers sometime back that some thought is going on developing Indian standard gold bar. So maybe once that comes and the enabling environment is created by the industry, probably banks can come into that way, and that will really give a very, very structured kind of a shape to this entire industry, which will be something which the industry has to do. Banks can only supplement their efforts. Banks can provide them the mechanisms for conversion of their raw material into their this thing. Now the gold monetization scheme. Now what people say is there is so much of gold available in the market, and you need to monetize that gold. My take is a little bit different. See, we extend loan against gold to agriculturists also, to individuals also. You have a lot of NBFCs who have gold loans against these ornaments. To my mind, it is nothing but a monetization of gold. Ultimately, why do you want a jewelry to be melted and again created? Why do you lose the value addition both ways? And if the gold is coming to the market, and if it can generate rupee funds out of that gold, whether you convert it into a gold bar or you do not convert it into a gold bar, it doesn't make much of a difference. Old GDS scheme was in operation for a long time, and we have not seen huge volumes in terms of, even though the temples have been depositing in these schemes, but that is only a part of it. So, to expect this gold monetization scheme to generate a huge kind of a gold supply in the market is, I think, too ambitious a target for anybody to achieve. And then when you are dealing with commodities, there are agencies, as a lot of people have said, there are CPTCs, there are refineries, there are locational issues, there are transitional issues. You have to have the mechanisms for all these things. And on top of it, since it's a new experiment, there are still lot of operational clarifications which have to come. So I cannot put the things into a proper system. So unless I have a mechanism, we operate at a huge, 16,000 branches. Maybe I am only operating for gold from say 100, 120 branches. But still I need to develop a system which can only be done when all the clarifications have come and all these issues or the risk factors, operational risk or the credit risk, all these things are sorted out. What problem we have faced with the CPTCs or the refineries is again the same. Because there are only a few CPTCs or a few refineries. Now if many banks are chasing only these people, they will not be able to really provide me a collateral with. So anyway, we are as a state bank, I think we have done the most in the gold monetization scheme. We are going in a slow way and a steady way. We are a conservative bank. We are not taking undue risk, but still we are providing a mechanism for making this scheme available to as many people as possible through our this designated branch network. And hopefully we will be able to really get into it once the market stabilizes. Now, what incentives can be given to the bank? I think the incentives are good enough and that makes sense for going for gold monetization, and that is what we are doing. Then the issues about this, operational issues is substantial investment by CPTCs, whether the returns are adequate on that. Now, whether you have to compromise on the quality of the testing on this, whether refineries are comfortable with them, and still there is no mechanism for disposal of gold. Total gold metal loan demand has come down, so a lot of unutilized inventory is lying. What to do with that? And there are issues which are market related, which are some things where market has to come. You have to come with a self-regulatory organization where you can set the standards for your own players. Then only the banks can come. Bank can come when there is a steady and a marketplace where you have a predictable marketplace. Otherwise, it becomes a little bit of a difficult. Now, role of hallmarking and this jewelers. Jewelers have already been permitted, so that is not a big issue. But again, the issue is that of the quality and what kind of processing they will do and what kind of refineries are going to be associated with different CPTCs. Then the third aspect of gold monetization scheme is the sovereign gold bond. I agree with Bhandari. It has been a huge success. I mean, in terms of, if not volume, and which is not the objective also, because there is a cap of 500 grams per investor per financial year. But as you were saying, almost I can just share with you, more than 8,000 branches spread across the country have participated in this. And the average ticket size of this sovereign gold bond in the last tranche was around 14 grams. So you can imagine that 50,000 people have invested, and they have invested on their own. And of course, there was a little bit of the marketing. It's a fantastic product, and what I will say is, it's very difficult to bring out the gold which has been stored by people for generations and for a long time. It's difficult to change the mindset, even though Professor Sahai has tried to do it, but my training of behavioral science says it's very difficult to change others. It is better that you change yourself. So what you can do is, really this gold bond can take care of the future demand. And then the other advantage which the industry is going to have is, you will have a price discovery which is based on the Indian trade, Indian prices. Because how it is priced is the IIGC price. It doesn't take into account all other factors which come into play when you are going for GML or for the gold monetization scheme or the gold deposit scheme. So you will be having a price discovery for this, and then hopefully that will help you in coming to a particular Indian gold standards also and the Indian fix also. But that is something which will happen over a period of time. But hopefully the sovereign gold bond will bring a kind of rule to the market, where you will have a price determined by the investors themselves. Right now, because the floating stock is very less, you have a lot of buyers but no sellers, which is what is the psyche of the average Indian. So that goes without saying, and to end the talk, what I will say is, we say that Indians have a mindset of holding gold. But if you see the current price trend in the market, why all this prices are going up because you have a Brexit fear, you have an international fear. So the best of the trade goes for gold. They feel gold is the safe haven. So what is wrong if an Indian feels so? I think heads off to the people who really know what is the real thing which doesn't give them the real protection against inflation or any other risk. With this I submit my initial remarks. Hopefully you enjoy it. Thank you.
So we have the initial remarks from our panelists. You would have already noticed the richness of experience each one that is bringing to the table is so very clear. So the house is open for questions. If there are any questions from the floor, I am happy to take them. Otherwise, we have some written questions and we could start with this. But let's first prefer. Any questions from the floor?
Hi. My question is for Ms. Dimple Chitnis and for all of you. When you talked about the risk management of the GMS portion of gold, as per my understanding, on the website, the RBI FAQs also mentioned that you can hedge that exposure also on domestic commodity exchanges. We have received some interest from some banks because our prices being duty paid landed prices and your exposure of gold monetization scheme is again domestically sourced gold. So that meets the hedging requirements perfectly, I feel. What is your opinion on that?
So when I mentioned about the GMS and the clarification that they gave for us to hedge the gold stock that we carry, typically you have to please appreciate that I also have a redemption that I have to carry out. And at that point of time, obviously that will be a parity to the market price. And hence, at that point of time, if I have to give a physical gold or if I have to pay in cash, specifically I have to give it a physical gold, there would be an impact of duty at that point of time to me. So in that context, actually for a bank, having this as an enabler tool will actually work in our favor because if I have to keep an open risk on the metal price, I don't think banks are incentivized to really push this product down the market. You have to repeat the last part because I was not audible at that point of time.
No, I mean all the three components, that is the gold price, the currency as well as the duty are captured in the domestic commodity exchange prices. So that takes care of your requirement better, doesn't it? At time of redemption as well as at time of hedging.
Right, it is.
Yeah. So which is why I'm saying that you should also look at domestic commodity exchanges as also advised in the RBI FAQs for hedging your GMS component of price risk.
Fair point. Okay.
This one is for...
Yes, sorry. Dimple, while you have the mic, another question for you which came in writing. An Indian gold coin is a part of GMS. Then why are their branches not selling Indian gold coins?
So just as we speak, this is obviously comes within the retail department of our bank. And as I understand, we're already in closure of agreements with MTC PAN on the same. MMTC, sorry, I didn't mean PAN. And we should be rolling out this very, very shortly at the branches. And hope to, probably what we're targeting is, the first week of next month. So hope to see gold coins available at the branches, so yes, fine for sure. I don't know about the other banks or this guys. Mr. Costa, I saw you when MMTC PAN just came out. So sorry for that.
That's alright. See, Indian gold coins sell, I think I saw MMTC also. See, what happens is you borrow a lot of gold from overseas suppliers and you don't give a collateral for that. Unfortunately, MMTC asked me to give a collateral for the sale of their Indian gold coins, which becomes a little difficult proposition. On top of it,
don't give them a credit line in future.
On top of it, I have my own gold coins, and it's a really difficult market to sell gold coins from a bank because, as you are aware that there is a discount in the market, they cannot compete with the others in the market. So it is a difficult task. Now Indian gold coin can only come because it is a sovereign, it has a Ashok Chakra and all that, but that will happen only after we have a mechanism in place which still is taking some time to build in. So there is one answer that we are not going in a big way for this. First we have to sort out with the MMTC and then software issues are there. And my own gold stock I have to exhaust and then only I can.
It is a good product for the customer in case I think banks are able to give competitive pricing and distribute well. and I think our distribution teams see it regularly. I think wherever it is, we keep
One is for you, Shekhar. As a very active bank in the bullion business, this is a straight question to you. Would you take a 7-year unhedged exposure on gold?
We are driven by our investment policy, and which is approved by the board. And if the investment policy and I think the board permits it, one would take it as on today.
Would you recommend to your board an unhedged exposure for 7-year gold?
Depends upon the trader's call and I think my props call. If they are able to convince me, I think request to the board.
You should have been in the foreign service.
And if rate of interest on gold metal loan is made same as repo rate, would it encourage GMS?
I think it is much less than the repo rate, so there is no sense, It cannot be compared with that. Metal gold loan is far less than what this rate.
That's a question which I would like
I'll only compliment that. I think gold metal loan is very much like a foreign currency loan. And foreign currency loan has to be benchmarked to a foreign borrowing or any borrowing in international currency. A LIBOR plus is one of the examples. And since we have a gold GoFos and I think gold rate, I think it is a fair rate and it is benchmarked against.
Here's a question for you, Dimple. Why banks are not comfortable to work with private refineries and CPTCs? Why banks are not comfortable to work with private refineries and CPTCs?
Honestly, I don't think that's the case, and I don't think banks are afraid of that. I don't know why I don't know who's put this question, but I don't know why you carry the impression that banks are afraid to work with CPTCs. So I'll probably put the question back to the person who's asked it because it's coming from the feedback which you have from a bank, and I don't think that's the case on the ground.
Yeah, see, what happens is, when there is an engagement with a CPTC or a refinery, basically he is going to hold gold on my behalf. Now, whether you have a rupee limit or you have a gold limit, you have a credit exposure on that. Now, credit exposures are hedged by way of, a detailed appraisal and a collateral. So, without having a collateral, no bank will have a risk approval for doing this kind of a business. The problem is, yes, it becomes difficult for CPTC, particularly in the current scenario where there is not much of a business. Particularly if the CPTC has got into agreement with 2 or 3 or 4 banks, he cannot provide the guarantee to all. So that is one of the factors which is hampering arrangement with CPTCs as well as the refineries. So the banks who have these refineries or CPTCs in their books, probably they will be better positioned to take a call on that. In our case, we have done wherever we have these.
Shekhar, there is this question that why banks demand 10 to 25% of value of gold as guarantee from CPTs. Related to the first question, they have invested heavily in technology as it is. So why does 10 to 25% of gold as guarantee?
Sir, the credit policy or the credit appraisal of each of the CPTCs and refineries has to be done independently. And if any bank is able to take it, I think convince itself and its credit team, then I think banks can go for 25% may be only recommended. It can be 0, yes, it can be 0, it can be 100%, in which case it can be 100% as well. So logically, I think this is where credit appraisal will happen. Thereafter, the recommendation comes purely, I think, the level of CPTC which you have seen as of now, rather than, I think, how they will build over a period.
I agree with the assessments of both the bankers here. I myself been a commercial banker and then a regulator because I worked in the Reserve Bank for a couple of years. I think that's a very right assessment. Refineries and CPTCs, yes, they do have the technology, but the risk is massive and therefore it's jamming. The question that the audience has is, who should be targeted to make GMS a success? Men or women? And why we have been hearing for some time that banks are likely to be permitted to buy gold locally and also be permitted to hedge on local exchange. And before we came here, we were talking about this, about the local exposure. So is there a case for this and when is it likely to go through? Of course, the question is to me, but because both of us were discussing before we came here, I think let's hear Mr. Lewis.
As far as the local purchase is concerned, there has been discussions with the Reserve Bank of India. Also, there was a discussion with the government, the finance ministry, with regard to local purchase, and I think we have had a couple of serious discussions on it. There is some clarification that the Reserve Bank of India wanted. We discussed that, and we are still awaiting their favorable response. And I think what it does, it helps the banks to get integrated with the local market. Presently, what the banks do are just doing agency business, getting importing gold and just either selling or lending in the market. But if we come into the local market and we're purchasing locally, I'm sure what will happen is the banks will get integrated into the local market, and there will be lots of opportunities. I'm sure it will also help in the GMS structure, because right now actually in the GMS we are taking gold from clients, and the banks are some of the banks are managing this in terms of purifying, assaying the gold and converting them into bars. So that practice is there. So if we can integrate our business in the local market, and definitely is going to be beneficial.
Before I conclude, I want to just mention this point here. This is not the best time for allowing local level banks, given the situation, the rising NPAs, to take the exposure. And also, being a regulator, and being a regulator in a country which is very conservative, necessarily has to be conservative, it's very clear that the risk which will be scattered so badly will not be permitted. So I would say take a couple of years before one can really think of local banks stepping in.
सर, आज की तारीख में जो परिस्थिति है उसमें पब्लिक के लिए जेएमएस स्कीम कब से स्टार्ट होगी? 9 महीना बीत गया लॉन्च होने के बाद में, तो पब्लिक के लिए छोटे इन्वेस्टर जो 5 किलो के नीचे गोल्ड जमा देना चाहते हैं, उसकी स्कीम कब से स्टार्ट होगी?
ये तो बहुत ही मुश्किल सवाल है, क्योंकि मुझे लग रहा है कि जितना मैं इसको देख रहा हूँ और 3 साल से जो मैं इसके बारे में पढ़ रहा हूँ या खोज कर रहा हूँ, मेरी समझ में तो यही आ रहा है कि हर जगह पे मुश्किलें हैं, अटकलें हैं, और वो अभी तक सॉल्व नहीं हुई हैं, ना ही मार्केट्स में सॉल्व हुई हैं। मैंने आपको बताया, मेरे अपने स्टूडेंट्स ने जाके रिसर्च किया है, सीपीटीसी में गए थे, उन्होंने कहा आज के बाद नहीं जाएंगे हम सीपीटीसी। ये पढ़े लिखे बच्चे हैं, उनमें से 3 औरतें थीं, तो जब फैमिलीज़ को वहाँ अगर जाना पड़े तो कैसे होगा? बैंकर्स की सिचुएशन आप सुन ही रहे हैं, उनकी क्या अटकलें और क्या क्या चैलेंजेस हैं। एक बात मानने वाली है, और ये हमारे पैनलिस्ट ने बहुत अच्छी तरह मिस्टर शेखर भंडारी ने उसको सामने लाए हैं, जहाँ उन्होंने कहा है कि सरकार एकदम सुन रही है बातें और स्कीम्स को मॉडिफाई कर रही है। तो मैं सोचता हूँ जब तक ये स्कीम परफेक्ट नहीं हो जाती है, उतनी देर तक कॉमन मैन के लिए लाना शायद ठीक भी नहीं। अभी ये टारगेट कर रहे हैं जीएमएस को, जहाँ पे टेम्पल्स पे बातचीत हो रही है। एक बार स्कीम परफेक्ट हो गई तो फिर ठीक है, कॉमन मैन के लिए लानी ठीक है। तो कब तक ये सारा कुछ हो जाएगा? मुझे लगता है इसमें कम से कम साल लग जाएगा, जब तक ये सारे ग्लिचेस सॉर्ट आउट हो जाएंगे, जो मेरी समझ में आता है। पर कंक्लूडिंग ऑब्जर्वेशंस में आई वुड रिक्वेस्ट ऑल माय पैनलिस्ट to address this question. It's a genuine question which many people have asked us. So just take a minute or two, each one of you, address this question. And there is another question which has come, which I think is, again, you can take it in your concluding remarks. What is the one internal incentive that will enable banks to pick up on GMS? That's another issue which has repeatedly been coming up, that if the bankers were wholehearted into the scheme, it would have gone to dizzy heights. It is not. So with that, let me start from this side now. We'll start with Mr. Shekhar Bhandari,
Professor,
and we'll close with Dimple.
The question is for the panel. Under the gold bond scheme, the sovereign gold bond, what can be the rationale, behind government taking price risk in issuance of gold bond? Basically, here the government is taking almost like 6-7 years of price call today it is issuing at X price, and at the end of the tenor, if the price, whatever the price may be, the government will have to honor that. So what could be the rationale behind government taking that price call?
Well, this question I have tried to answer in my own newspaper articles, and I would just like to mention that the government securities market as it prevails today, in the initial years when I was the Reserve Bank, I was trying to set up the government securities market. 91 to 93, I was there trying to set it up. Now the issue that you are raising is very similar to that. This has been debated many times in newspaper columns as well as the government, the price risk. Even before coming to you, the panel, as a panel, we were discussing this issue. How do you handle this price risk? And why is the government taking it? And of course, one of the ways to tackle it is have different maturity profiles. That is one way to tackle it. 2 years, 4 years, 6 years, 8 years, 10 years, bond life. The other way to tackle it is analyze the cyclical pattern of the gold prices. Gold prices have been moving in different directions. They have been in the range of 10, 60, 11. And they sometimes rise to $1,400 per ounce. So if you plot the cyclical pattern, be it the positive trend or be it the negative trend, consists of long-term cycles, medium-term cycles and short-term cycles. You can design your product accordingly. The third, I am of the opinion that the demand for gold in this country, and that takes me back to the question which Professor Sahai was trying to answer, and my colleague here, the panelist from the State Bank with his rich experience has tried to answer. Why do Indians need gold? Why do they invest in gold? They invest in gold not because of defect in their brain. They invest in gold like the rest of the world invests in gold whenever there is uncertainty. That's what I've tried to show in my research. Indians are wise. They do not have alternate instruments. And this is one instrument that fits in the economy of the country, given the economy, given the black money, given the lack of opportunities, given the fact that there is no old age pension, no social security. To buy a house, I need a lump sum. To buy a gold, even my servant can start building gold reserves from her monthly petty salary. So gold is very unique. It serves a very important purpose in this country. Globally, whenever the US is in trouble, Euro is in trouble, the gold prices shoot up and we say gold is a safe haven. When in India, inflation rises, when there is uncertainty, gold prices go and people start buying gold. It's obvious. They are addressing uncertainty. And I would request, I had done one plot in 2013. If you plot the imports of gold and inflationary trend, you will be surprised. It matches 1 to 1. Again proving the fact that gold is being used against hedging. The second fact, in cities, in urban areas where most of us come from, we have alternative sources of investment. In rural areas, where is their investment sources? And 70% of the gold, as 70% of Indians live in rural areas, they invest in gold. Do a survey, and at least I'm not saying you more than I know, but when I did the survey in rural areas of Bangalore and Kuppam, I was so surprised, so impressed, that we think that naive Indians do not know basics of finance. I was so surprised. They are far ahead of me in knowing the basics of finance. So therefore, your question links to the prices, and your question of prices then links to the pattern of demand in this country on gold. I would say, in my analysis is, that in the equity market, in the stock markets, the educated people, many are speculators, very few investors who want to hold on a long-term basis. In gold, it's the other way around. Most of us invest in gold for very long term, for education, for marriages, for long-term investments, and it is intergenerational many, many times. So therefore, that fear of price risk, to my mind, can be addressed and is not too much feared of. Let me request the panelists in the order I mentioned to give their closing remarks for 1 minute each.
I request everyone to have a look at the new campaign which the government has launched very recently on cleanliness. And I think on the consumer and etc. If we have seen, I think the way the goddess Lakshmi, which is everyone worships and looks after, and I think is fond of. So I don't know whether it's launched today or etc. But I saw it, I think, while coming from airport to I think Agra over here, which was forwarded this thing where Amitabh Bachchan and Kangana Rao are the ambassadors who are endorsing that a person who is worshipping Lakshmi, as soon as he throws garbage on the road, I think the Lakshmi goes away. I think a fantastic message which I guess could connect or can connect with every Indian and when they were to look at it. I hope it has been launched today, came to me, and it will be something which I think the gold marketing team needs to learn from. Good schemes I think has to be probably brought into everyone's mind, and it's a constant process. I think you have to just keep on.
हर्षद भाई, आपके सवाल का जवाब ये है कि हमने ऐसा है कि छोटे छोटे जो 500 या 100 ग्राम वाले हैं ना, वो भी क्लाइंट्स हमारे पास आए हैं। अभी दिक्कत ये है कि अभी सब जगह पर हमारा ये अरेंजमेंट नहीं है। जहाँ पर है वहाँ पर उसकी क्वांटिटी का कोई इशू नहीं है। और नागौरी जी का जो सवाल था कि व्हाट द गवर्नमेंट इज थिंकिंग इन टर्म्स ऑफ द हेजिंग ऑफ दिस ना, व्हाट दे वन ऑफ द thoughts is, they are borrowing from the market rate, say 8%, or maybe the rates have come down now, whereas this borrowing comes at 2.75. So with this interest differential, you can create a gold reserve fund which can take care of, in case the prices go up in future, when the liability comes, we can draw upon this resource also for hedging that risk. Apart from what sir is saying, there will be a perpetual issuance where you will be basically rolling over your liability to the future, and average price over a time horizon of 10 years, 5 years, they will get an opportunity of sparing off their liability.
I think one of the most important things since the GMS was launched, and what we have seen is the government has taken really serious participation in this, and in terms of, I have seen there have been lots of meetings and to answer some of the questions, basically why it is not really picked up. There are still a lot of gaps, and I think day by day we are seeing that we are understanding and we are learning. The banks are experiencing some issues which are being addressed, and I think as Professor mentioned, that it's going to take some time. We have to keep ironing out any rough edges and ensuring that we can give the people the right products, and we will not have a perfect product, but we will be at least close to something perfect.
I think the good part here is that the government is working very closely, and Reserve Bank is taking very, very close inputs from banks, and this is probably, I'm seeing a very collaborative in all three entities and taking our views in understanding methods to look at the CAD issue in the country, thereby monetization becoming a very, very critical product and a tool. I would leave a few thoughts, for the forum, and I don't know, maybe the next time we meet a couple of years down the line, some of these things may have been rolled out for all of us. Let banks participate domestically in buying. Let maybe a gold metal loan be paid off by bullion. I don't know if that works. Let banks be allowed to export bullion, another radical thought. To be able, see, the idea is that we want to be as competitive as what the local market is, and be able to pass on that advantage to our customers. I guess that's what the end result is. And as far as the government initiatives go on deposit as well as on the bond scheme, I think brilliant initiatives. I think a couple of years down the line, GMS should also kick off. Maybe government can mandate trusts and temple trusts with some ruling that they have to necessarily invest certain part of this gold through the scheme, and also induct other banks. So just leaving these few thoughts for the forum.
One thing is very clear from today's discussion, both from the bankers on the panel as well as from the audience, that there are expectations which need to be fulfilled, and the work is half done. Much more remains to be done. By the way, when I was in the Reserve Bank, and I'm sure Mr. Lewis experiences like that, The Reserve Bank can always ask, I supervise and regulate the commercial banks. What is the core business of a commercial bank? Is gold the core business of commercial bank? If not, why blame them? So we have to think, how do we tell the government that gold business can strengthen the bottom line of a commercial bank and therefore it can be added on. If you look at global experience on gold and gold related products is also not too heavily loaded, and therefore one has not to blame the central bank. One has to understand the difficulties of the central bank and then ask the commercial banks how much pressure they can take or not take. In any case, the conclusion is clear. The situation is complex. And why I say the situation is complex, you can tell me the example of Turkey over and over again, but Turkey doesn't stand anywhere in comparison to this country for the following reasons. The spectrum of population we have, the income levels that we have, the different languages that we have, and different languages bring different culture. As I mentioned to you, my students did a survey cross country and they found there are different preferences vis-a-vis North and South India, East and West India. And you have to come out with one scheme which addresses all these complexities. It's not easy. It's a challenge, and obviously these challenges take time. I want to just mention two last points. One is financial literacy is lacking. And I think the point again which Mr. Shekhar Bhandari is bringing, the way the brand ambassadors have been roped in, probably that will help in improving the financial literacy. The last point I want to make is, there is uncertainty, and by now it should be clear that gold is playing a very important role global and domestic markets to address uncertainty. We all, and the government especially, has to see that there is reduction of uncertainty in the country, in the economy, and then only the reliance on gold will probably come down. Only then people will be happy to share the gold that they hold and not hide it further and deeper. With that, let me conclude this session and thank the organizers once again for holding and inviting us for this session. Thank you.
Professor Charan Singh, I would request you to present a memento to each of our participants on the panel. Mr. Prashant Upadhyay, State Bank of India. A memento for Mr. Shekhar Bhandari. Ms. Dimple Chitnis. Finally, of course, Mr. Johnson Lewis. I would like to request Mr. Sunil Kashyap of Scotia Bank to present a memento to Professor Charan Singh.